Your savings are becoming less protective, even as they grow inside index funds, and the shift is not visible in your account balance. The numbers increase, the charts look stable, and diversification appears intact. Yet the protection those investments are assumed to provide is quietly changing. The cause is not a market crash, not a mistake, not a failure of discipline, but an assumption embedded in index investing that is no longer aligning with how markets are behaving now. Most people believe index investing is the safest long-term approach because it spreads risk across the entire market. It feels rational, it feels responsible, it removes the need to predict, to time, to select. Instead, it relies on the idea that markets, over time, distribute risk efficiently and reward patience consistently. This belief has been reinforced for decades, supported by performance, simplicity, and widespread adoption. But the outcome begins to drift in ways that are not immediately obvious, because the structure supporting that belief is quietly changing underneath it. What people notice first is subtle. Market movements feel more synchronized. Entire portfolios move together more often than expected. Gains appear concentrated in fewer places, while broad exposure feels less diversified in practice than it appears in theory. This is the visible effect. It does not look like risk increasing. It looks like normal variation. But the pattern begins to repeat, and repetition creates a quiet tension between what diversification promises and what it delivers. Beneath that effect is an invisible mechanism that rarely enters consideration. Index investing does not just reflect the market, it also directs money into it in a specific way. Capital flows automatically toward companies with larger market weights, reinforcing their position regardless of underlying change. This creates a feedback loop where size attracts more capital, and more capital increases size. The system appears passive, but the flow is active, and that flow shapes outcomes in ways that were not originally assumed. As more money enters index structures, this mechanism intensifies. The market begins to respond less to individual differences and more to aggregated movement. Companies are bought not because they are selected, but because they exist within the structure. This shifts how risk is distributed. It becomes less about individual exposure and more about systemic alignment. The assumption that diversification reduces risk begins to weaken when the components being diversified move in increasing unison. People respond to this environment in predictable ways. They continue to allocate consistently, increase contributions, and rely more heavily on index exposure as uncertainty grows. This behavior feels disciplined. It feels aligned with long-term thinking. Yet it also reinforces the very mechanism that is reshaping the market. Each contribution flows into the same structures, strengthening the feedback loop, increasing concentration, and reducing the independence between assets that diversification depends on. Over time, this creates a structural lock-in. The larger the index becomes as a share of total capital, the more the market reflects the behavior of the index itself. Price discovery begins to shift. Instead of being driven primarily by individual assessment, it becomes influenced by the direction and scale of passive flows. This does not remove active participants, but it changes their relative influence. The system begins to stabilize around its own structure, making it harder to separate true diversification from perceived diversification. At this point, the difference between holding many assets and holding independent assets becomes significant. Index investing assumes that owning a wide range of companies distributes risk. But if those companies are increasingly connected through shared flows, then the independence between them decreases. The portfolio still appears broad, but the underlying exposure becomes more unified. Risk does not disappear. It concentrates quietly within the structure that was designed to disperse it. This is where identity begins to intersect with the system. Saving regularly, avoiding unnecessary risk, and trusting established strategies all align with index investing. These behaviors are not flawed. They are consistent with what has worked. They represent discipline, patience, and long-term thinking. But they also synchronize with a structure that is evolving. The more consistently these behaviors are applied, the more they contribute to the same system that is changing the nature of the protection they are expected to provide. The recognition forms gradually. It appears when diversification feels less effective during periods of stress. It appears when large segments of the market move together without clear differentiation. It appears when stability seems dependent on continued inflow rather than underlying variation. None of these moments are dramatic on their own, but together they suggest that the system is not operating exactly as assumed, even though it continues to function. As time passes, the cost of this shift becomes more visible, not through loss, but through limitation. Optionality narrows. The ability to rely on diversification as a protective mechanism becomes conditional. It depends on the structure continuing to behave in a certain way. When that behavior changes, the protection changes with it. The portfolio still holds many assets, but the benefit of holding them becomes less distinct. What once reduced risk now begins to redistribute it differently. At the same time, participation becomes more embedded. The longer capital remains in the system, the more it becomes aligned with its structure. Exiting or adjusting carries implications tied to timing, scale, and coordination. This does not make movement impossible, but it increases the weight of decisions. The system favors continuity. It rewards remaining within its framework, not through explicit incentives, but through the increasing cost of operating outside it. This creates a subtle dependency. Index investing is not just a strategy. It becomes part of the market structure. Its growth changes how the market behaves, and that behavior feeds back into the perception of the strategy itself. The assumption that the market is an external environment begins to blur. Instead, the strategy and the market become interconnected, influencing each other in ways that are difficult to separate. At this stage, the original assumption is still present, but its conditions have shifted. The belief that diversification reduces risk remains valid within a certain structure. But when the structure changes, the outcome changes with it. The system does not announce this transition. It continues to operate smoothly, maintaining the appearance of stability, even as the underlying dynamics evolve. The cost is not immediate. It accumulates over time through alignment. Money continues to grow. Contributions continue to be made. The system continues to function, but the relationship between exposure and protection is no longer fixed. It becomes conditional, dependent on factors that are not directly controlled by the individual participant. Eventually, the realization becomes difficult to avoid. The strategy that was designed to reduce dependence on individual outcomes begins to depend more on systemic behavior. The safety it provides is no longer purely structural. It is contextual. It relies on the continuation of patterns that were once assumed to be stable, but are now being shaped by the very strategy designed to rely on them. Nothing appears broken. There is no clear failure point. The system remains intact. But the assumption has shifted, and with it, the nature of risk. What was once distributed begins to align. What was once independent begins to move together. What was once protective becomes conditional. And once that shift is seen, the question is no longer whether index investing works as intended, but what it has quietly become part of as it continues to grow within the system that defines it. Thanks for watching. If you'd like more calm, long-form thinking about investing and money, subscribe to Finance Simplified.